All right. Well, looks like we might be at a great time to start. Mandy, would you mind just going back one slide, please? All right. Thank you. And welcome to everyone joining us on this Wednesday late afternoon. We really appreciate all your time and interest in today's topic, and we should have a full house today with over 175 people registering for this webinar. Most of you are Summitry clients. There are also folks interested in becoming clients, and we have some business partners joining us as well. Now, you're all here for today's webinar, Estate Planning Essentials for 2025. Next slide, please. First and foremost, let me introduce the team that we have here. Today's webinar is brought to you by Summitry's Financial Planning Committee, composed of Mandy Pham, Senior Financial Advisor and Director of Financial Planning here at Summitry, Ken Vanderkooy, Senior Financial Advisor, and myself, Daniel Spector Franson, Financial Advisor. All of us are certified financial planners, and Mandy Pham is also a chartered financial analyst, an enrolled agent, and has a Master of Science in Financial Planning. Now, before I introduce Gary, I want to share with you all what our Financial Planning Committee is designed to do, which is to provide oversight for the firm's financial planning practices to ensure consistency and high-quality planning solutions for the firm's financial planning practices, leading to the best possible outcomes for clients. We work with our investment team to ensure return assumptions are consistent with the current environment. We collaborate with the advisory team to stay current with tax and estate law, and we share planning-related developments and our insights through blogs and webinars. We are also joined by Gary Machado, attorney and board-certified specialist in estate planning, trust, and probate law, and partner at Watson and Machado. For some of you on today's call, it is very possible that you have worked with Gary or members of his team, as they have been a valuable resource for our clients for many, many years. Next slide. Now, I have the enjoyable job of moderating today's webinar. We have about a half hour prepared content, and then we'll have 30 minutes afterwards for Q&A. Should any of you have questions during the presentation, I ask that you submit them in the Q&A box at the bottom of your screen. We will get to as many of them as we can at the end of today's talk, and if we run out of time, I'll ask that you reach out to your Summitry advisor directly, and if you're not a client, you can email us at hello@summitry.com. For those of you watching the replay, please reach out to your Summitry advisor. So in this session, we will cover the importance of creating and revisiting an estate plan as life evolves, understanding the key roles in an estate plan and their responsibilities, and then we'll shift gears and talk about the estate and gift tax landscape coming into 2026 and strategies you may want to consider, and how to have a meaningful and timely estate planning conversation with family. Before we start, I'll just reiterate one more time that if you have any questions, please submit them in the Q&A box below or reach out to your Summitry advisor directly. With that, I'm going to turn it over to Mandy.
Thank you so much for the wonderful introduction, Daniel. So for my part of the presentation, I prepare a few case studies so that we can share the importance of estate planning, the focus of estate planning throughout different stages of life, from a young individual to someone who thinking about legacy planning. But at the beginning, let's be level set and define what is an estate plan. At the core, an estate plan is a collection of documents that will manage or appoint people to help you manage personal and financial affairs in the case of incapacitations or death. A basic estate plan usually includes a revocable living trust, a will, durable power of attorney, and advanced healthcare directive. The will and the revocable living trust describe how a person wish to distribute asset at the end of his or her life. The revocable living trust generally control the trust asset, and the will would control non-trust asset. In California, what we see is that planning attorney like Gary generally recommend the revocable living trust as the main deposited vehicle to avoid probate because it can be a lengthy and costly process, and then they would prepare a pour-over will that would have any asset that not currently part of the trust to be transferred into the trust at the time that the person die. The durable power attorney, there's two durable power attorney, could be a financial durable power attorney or medical durable power attorney. So these are legal documents that give a person legal authority to make decision on your behalf, whether it's medical, financial, or on property. And lastly, Advanced Healthcare Directive is a document that expresses your wishes when it comes to critical care, life-sustaining decisions. And in California, in particular, the Advanced Healthcare Directive is also the document that you would appoint the medical power attorney. So there's a lot of terms that I just throw at you. So these, in summary, these are the key people in an estate plan. A big part of the estate plan is to name the right people in the right place. So the three people up top, trustee, executor, agent for power attorney, are the people who are going to help you manage financial affairs during incapacitated or a death. So that would include paying bill, managing investment, filing taxes, paying off debt, and eventually distributing asset to beneficiary after that. Trustee and financial power attorneys are active during your life, and after death, the trustee still remain active, and the executor come in play for non-trust asset. It's a lot of terminology. In many cases, what I see is it makes sense to name the same people in these three key financial roles. Um, when thinking about candidates for this role, you feel useful question that you can ask yourself is, do you trust this person to make financial decision on my behalf? Does this person have the time and capacity to commit to this role? And can this person hire and work well with an attorney or financial advisor to help manage the asset over time? Because many clients have a trustee that will play an active role in their, let's say, minor children for long periods of time. So it can be an ongoing role for a long time. The medical power attorneys, again, is the agent who will make the decision when it comes to medical care. It could be something like a routine medical care, particularly when some client can be in dementia for an extended periods of time, or it could be a life or death decisions in case of an emergency. So as you consider a trusted person for this role, a few questions to ask yourself would be, can this person remain calm and logical under stress? Because this can be a very stressful situations. Does these people support my healthcare preference? Do they know my healthcare preference? And having the person nearby could be a plus in this situation. And guardian is applicable when you have minor children. So they are literally the people who raising your kid when you're not around. Beneficiary is self-explanatory. They are the people who receive the asset and benefit from the estate. Um, so let's talk about how estate planning focus can be different at different stage of life. The first person that I want to focus on is Sarah. She's a young professional. She's starting out her career. We may have a few Sarah in the audience. I definitely know that we have parents and maybe even grandparents of Sarah in the audience. Being young, being single, and still in the well-building phase, estate planning is probably not top of mind for Sarah. However, being an adult, meaning that Sarah's parents no longer have the authorization to make decisions for her or to even inquire about her situations. So it is important that Sarah have a legal document to name the people that she would like to get the help from in case of emergency. So medical power attorney is probably the first thing that comes to mind. Um, It allows someone to obtain information from her doctor and nurses. It allows someone who help her make medical decisions. It could be her parent, it could be her sibling. On the financial side, Sarah probably have her asset in her 401k and a few financial account. Beneficiary designation for those accounts might be sufficient. And as her asset grow, Sarah might want to consider setting up a basic will and trust structure for herself. Moving on, we have Dave and Kate. They are mid-career, juggling raising children while managing their ever-growing job responsibility. They probably don't have a quiet moment to think about their estate plan. I can talk about it from my personal experience and probably Daniel as well. For Dave and Kate, there's children, their two young kids are their whole world. So naming trusted adult to take care of their children in case that they are not here is probably one of the most important decisions that they can make. It's also likely be the most daunting decision. It's very hard to think about these situations. The guardian, as part of the will, they can name guardian who are the person who will providing shelter, providing food, providing educations until the child turn 18. Just as parents, the guardian will make decision anywhere from what movie the child going to watch to what college, who they hang out with and what college they go to. So have a huge influence on the child's life. On the financial side, they probably want to name a trustee who help managing their asset for the benefit of the children to a certain age until the child are deemed ready to manage their own finances. It could be for some parent it is 25, some parent it is 30, some parent it is 35. And it could be stages for a portion of the asset as well. The trustee and the guardian can be the same person, but they don't have to. In many cases, there might be benefit of having the guardian and the trustee are different people, so we have a check and balance situations. And then, of course, Dave and Kate also need all of the other core estate document that we talk about. It's important to note that spouses doesn't automatically have the authority to make decisions for each other, so it's important to have the power of attorney in play as well. The next one, then we have Tom and Susie. Tom and Susie's late stage career, they have accumulated significant level of wealth throughout their successful career. Tom and Susie, the additional focus on their estate plan would be on income tax and estate tax minimization. Potentially create an annual gifting strategy to utilize the annual exclusions. They can also give highly appreciated asset to potentially shift some of the income tax to the next generation as well with careful planning. For many, Tom and Susie would be very prime candidate for some of the more complex estate planning technique that Gary will discuss in the next portion of the presentations. And for many of my clients in Tom and Susie stage, I also encourage them to talk to their parent to coordinate their estate plan with their parent estate plan because many of Tom and Susie might have an estate tax problem on their own. So it might make sense to the extent that they have confidence in their financial plan to make sense to skip a generation. Maybe have a conversation about how the trust that the grandparents set up might be for the benefit of the grandchildren as opposed to themselves to avoid double taxation. It could be the 401k that they inherit might be taxed at the highest level for income tax situation. And it could be that potentially we name the grandkid as the beneficiary. So those are the kind of conversations that tend to be the focus for Tom and Susie. And trust provision for children is still important, particularly when the estate is large. They might want to have asset keeping in the trust for a longer periods of time for greater protections or making sure that their children don't commingle asset in a community setting if they live in the community state like California. Um, okay, let me see how I can move this slide. Okay. And our last one is John and Mary. They also have significant estate value. Durable power of attorney and medical financial power of attorney will be very important for them in this stage because they are much more likely to need someone to act on their behalf. Particularly what we see now is they're more likely to need to go into a hospital. We see many older clients face a longer stage in dementia that we really need the help from the durable power attorney, both medical and financial. And then legacy planning, talking to the Tom and Susie, who are their children, create a real lifetime wealth transfer to minimize income tax and transfer tax is very important for Tom and Susie. So in summary, there are three main goals for an estate plan. First one is efficient transfer of asset. The second one is incapacity planning, and the last one is planning for minor children. And the focus of the estate plan might be different at different stage of life. So it's important for you to not just set up an estate plan and forget it. It's important to review every 5 years, and making sure that the foundation document is in place, making sure that the fiduciary that you name, the key people in the estate plan are still the right people for the role, making sure that your asset is titled correctly and the current beneficiary designation are still correct, and then optimize the estate plan as your asset grow, as your children growing up, as there's new people in your life. Gary, I think this next part is for you.
Wonderful. Thank you, Mandy. And thank you all for being here, and happy to expand into the next section here about estate and tax planning strategies. I think first and foremost, I'll start by saying that the area that Mandy just covered, we oftentimes refer to as our basic planning, which is important for everyone to have in place. And the basic planning still has strategies involved in it, which I'll get to in a minute. And then there's a second world of what we call advanced planning that we'll also be getting to in a minute, that involves other types of trusts. And oftentimes those are irrevocable trusts as compared to the revocable living trust that Mandy was referring to. And one of the key items that gets us into the advanced planning world is estate tax, and other tax planning that we're trying to address. So kind of as a primer here, we'll start with what is estate tax, and make sure we're all on the same page as we proceed into some of the advanced planning techniques. Really common to get a call from prospective clients, asking, what do I have to pay when I inherit something? What is the inheritance tax is often noted, or do I owe income tax when I inherit something? And it's best to just explain first that no, the structure around inheritance and death taxes and all these other terminologies that get used in the US is what we call an estate tax. Okay. And for those of us living in California, and I'm a California attorney, there is no state level estate tax, but there is a federal estate tax. And what does that mean? It means that when someone passes, we add up the value of all of their assets, whether that's held in their revocable living trust, or it's the painting on the wall behind me, or it's their car, right? You add up the value of everything they own, and it's the value of it as of their date of death. And we say, is it under or over the estate tax exemption? right? And as you'll see on this slide, the estate tax exemption is something that is set by the government, and it fluctuates over time, as many tax laws fluctuate over time. The current estate tax exemption is $13.99 million per person. So quite high, quite high. So going back to that kind of anecdote that I was raising, someone passes, we add up the value of their assets. Under the current laws, you've got, I'm going to say 14 because it's shorter to say. You've got 14 million of exemption, 13.99. And if the total value of all of those assets were over the exemption amount, the amount in excess would get taxed. Okay. If it's under the exemption amount, no estate tax is owed. All right. So that's really it at its core. And so as you can see in the slide, it's gone up, up, up over time, and it's currently at this $14 million number. And the $1 million question, or perhaps the $7 million question that everyone probably has on their minds today, I certainly do. It's something that's hot in the news, or at least the news that estate planning attorneys read, is that the current laws are set to sunset at the end of the year. And if nothing happens, the estate tax exemption will go down from its current $14 million to what we predict to be $7 million. And the reason for that is the prior law that was in place when the new Tax Cuts and Jobs Act went into effect, doubled the exemption, which was already indexed for inflation. So it was around $5 million, ticking up with inflation, and then it doubled. And you see in 2018, that's where it climbed considerably. It ticks up for inflation, which is how we got to this current 13.99. And if that were to sunset and revert to the old law, it would go back to that 2017 number and then get an inflation adjustment and end up somewhere around $7 million. And so when we're thinking about tax planning within our estate planning world, we're thinking about, okay, is it likely that I'm going to owe estate tax? And if that's true, then what can I do to mitigate that risk? I mentioned before that California does not have an estate tax, which is correct. Some states do, and it would be kind of beyond the scope of today's presentation to get too into the weeds in that world, but I think it's just something to be mindful of and something to speak with your advisors about. Would be, if you had assets in other states, is there a risk that on your death, their state estate tax would apply? And it varies obviously from state to state whether or not they have them. But as is frequently the case, those numbers are quite a bit lower than the 13.99 that we're looking at right now at the federal level. So hopefully that primer on estate tax gets everyone relatively up to speed as we dive into the next slide, and we will start to explore in a little bit more detail what our opportunities are to address. So should you take action, right? Okay, thank you, Gary. I now understand what the estate tax is. What do I need to do? Obviously, the answer is it depends. It depends on a number of factors, but in the context of estate tax specifically, the estate value, right? What does your estate value look like now? And what do you envision it could potentially lead to? And how does that overlap with the estate tax exemption amount, right? Obviously, if you are well over the current $13.99 million, and I'm going to get into in a minute how we look at it when we're talking about married couples. We'll get into it in a second, but strictly at the individual level. If you're well over the $14 million, then you obviously have a potential estate tax exemption, potential estate tax on your passing. If you're in that kind of $7 to $14 million range, you obviously are looking towards the current laws a little bit more, and whether or not that law is allowed to sunset, or if it gets continued in its current form, or perhaps revised into some form we've never even thought of before. And if you're under, again, same vein, you don't know, we're thinking about where your assets may potentially appreciate into the future, and whether those laws could revert to some lower number. When we get outside of just thinking of purely numbers, we're also thinking about lifestyle goals. Anything that we implement in our planning strategies inevitably carry some consequence outside of the estate tax world, right? It could be that assets are put into some more restrictive type of vehicle, like an irrevocable trust, or they're otherwise, divided into fractional interests, or some other planning strategy that we explore, and those objectives need to match your non-tax objectives, right? What I think of advanced planning and even basic planning for clients, I always want to be mindful that we don't let tax be the sole driving decision maker, because oftentimes if you strictly optimize for tax planning, you're going to do so at the expense of other planning objectives that aren't necessarily financially driven. In a similar vein, lifestyle goals could simply be, what are my anticipated lifestyle goals for the rest of my life? You could put a whole lot of planning into minimizing the size of your estate now. But if you also plan to spend down your estate over the duration of your life, or perhaps even if you don't and an estate tax is owed, you might not mind. You might prefer to retain as much as you can for your own use and benefit. And if a higher tax is paid at the end of the day, and your heirs inherit a little bit less, so be it. And so that's why we're constantly trying to balance those with one another. And then similarly, there's competing objectives in the estate planning context, and even in the tax planning context, when you're exploring these various strategies. I'll give you a simple example, and we can stay on this slide, but we'll get into more detail in a bit. But I'll give you a simple example in the context of what we refer to as a step up in basis, which is to say that if I were to gift something to a family member now, they would receive the basis that I hold in that asset from a cost basis, income tax, perspective. And if I were to die and leave it to them, they would receive what we call a step up in basis, meaning their new basis would be the value on my date of death. So if I bought a share of stock for $1 and I gave it to someone and then they sold it for $2, they would receive my $1 basis and owe $1 of gain. Whereas if I bought it for $1, died when it was worth $2, and left it to them, they would receive the $2 basis on my date of death. If they sold it for $2, they would have no taxable gain. And so we're thinking of things like that when we're working with clients to come up with the plans to say, yes, there might be an estate tax planning objective here, but balance it against, does it make more sense to hold on to this asset and pass it to my heirs on my death, and ensure that they're able to receive it and liquidate it quite quickly. Similarly, there are things in California, as I'm sure many of you are aware of. There are planning I was going to say opportunities, though that window is becoming quite a bit shorter in recent years. But there's property tax planning that we want to be mindful of in the same vein. It used to be quite simple to gift or even sell, but to transfer property to family members, particularly children, and they would be permitted to retain your same property tax basis for property tax calculation purposes. That window has been closed quite a bit since the passage of Prop 19. And so oftentimes, again, when we're exploring how can I do some estate tax planning, we want to be careful that we're not inadvertently triggering reassessment of property taxes or any other tax planning consequences that we're perhaps not trying to address. So, but keeping all of those general objectives in mind, I'm going to circle back, and we can still stay on the same slide, but I'll circle back to the overall strategy, which is to say, if I could potentially owe estate tax, what could I do? And in the concept that everyone needs to understand is that estate tax exemption is actually what's referred to as a gift and estate tax exemption. It's a lifetime gift and estate tax exemption because the IRS is aware that if you could just give assets away while you were alive and not own them on your death, they wouldn't get their estate tax, right? And so what they've said is you can gift during your lifetime and use the value of the assets that you've gifted to reduce that exemption, or you could hang on to them, use the exemption on your death, or some combination of the two. And so what we're thinking about when we're considering getting into these advanced planning strategies is, does it make sense for me to get the future appreciation out of my estate while I can now? And so, for example, if I were to gift my children $1 million of stock valued as of today's date, I would use $1 million of my lifetime exemption. So I would go from 13.99 to 12.99. And then the $1 million of stock in the hands of my children, if it were to appreciate, say, to $3 million, that 2 million of gain, that 2 million of appreciation occurs in the hands of my children, not in my hands. And so when I die, yes, I have $1 million left of exclusion, but I have 3 million less of assets in my estate. And so that kind of at its core is what we're balancing against one another, is maximizing the planning around the estate tax exemption, but also, as I alluded to before, not getting tripped up on things like the stepped up in basis that I alluded to, not getting tripped up on property taxes if we're talking about gifting real estate or anything in those veins. And then similarly, the estate planning goals, the charities versus heirs note in the slide, also just thinking about who you're leaving your assets to. Ultimately, who are you trying to benefit, and taking that back and separate from the tax planning objectives and making sure we're providing for those that we want to provide for. And oftentimes when we're getting into the gifting world, in that advanced planning world, once it's been gifted, you can't take it back. And so we want to make sure that we're setting up these plans for folks that are here and ready to benefit. So we can move to the next slide. I alluded to before that there is some estate tax planning that occurs within the basic estate plan, and that the best way to summarize that is to say that you're not avoiding estate tax. You're not the assets are still in your estate when you're putting them into, say, your revocable living trust. But what we're trying to do is navigate the current rules to make sure we're not inadvertently paying taxes really sooner than we should, and we can put some strategy into future appreciation. And the bulk of that comes about in the case of married couples. And so going back to the estate tax exemption, which I'll call around $14 million right now, that's per person. So a married couple, it would be 14 million per person. And so we think of them as having a combined $28 million exemption. And so when we're looking at the total value of the estate and whether potential estate tax could be owed, we're generally viewing it from that combined dollar amount. But what we can do is we can work within their revocable living trust so that when the first spouse passes, the assets are either distributed to the surviving spouse in a continuing revocable trust, or being distributed to a surviving spouse in an irrevocable trust, and structuring those trusts in a way where we help make sure that the estate tax is minimized when both pass. Certainly that estate tax is not paid when one passes. And also balancing in the other tax planning objectives I mentioned, like step ups and basis, and ensuring that if it's possible, we can get a step up each time a spouse passes, so that if assets are sold, less capital gains are paid on the sale. And we're planning kind of throughout that structure. We could do a whole hour or more on all the different intricacies of these different trust structures. So I'll spare you all the level of detail here, other than to say that many of you are probably familiar with the traditional ABC trust, which is kind of still a very solid trust structure, but it's really antiquated in its applicability, in the sense that it's really best for folks who will owe an estate tax, and they're sure that they're going to owe estate tax, and frankly are quite above the exemption amount. For folks who are under the exemption amount, we're quite frequently now revising those old structures, or if they don't have a trust in place, putting in a new trust that follows what we call the disclaimer trust, or the AC trust, which is really designed around acknowledging that both spouses' combined exemption is probably going to cover the total value of the joint estate. And we want to just make sure that we're getting that step up in basis, because it's really unlikely that estate tax will eventually be owed. And so that's generally the idea around the revocable living trust, and how we're planning for estate taxes, and with a little overlay of income tax planning around step ups and basis and whatnot. So if we reach a point where we say, okay, no, we want to do some gifting here, then really what we're looking at is what type of gifting should we be doing. On top of the estate tax exemption, the IRS gives us what they call an annual exclusion. Most folks think it's 14,000 because it was in the past. It's also been incrementally ticking up over the years. The current annual exclusion is 19,000. So that's 19,000 per recipient, per donor. So I can give as many people as I want, 19,000 in each year. If I go over that 19,000, I file a gift tax return and I report that I gifted more than my annual exclusion, and I reduce my lifetime gift and estate tax exclusion. And so those are really your two strategies from a gifting standpoint: staying within the annual exclusion or going over. And then the second question is, am I going to just give this outright, or am I going to give it in some type of irrevocable trust with some structure to it, right? You certainly could just give shares to a child who's an adult, or to a sibling, or to a friend, or whomever. But you could also put it into a trust, put some bells and whistles in place and say, yes, I'm comfortable giving my 5-year-old $1 million of stock, but no, I need somebody to look after it for them until they've reached an appropriate age. And so that's where irrevocable trusts come in, where we want to make a completed gift that achieves the same tax planning objectives as the outright gift, but it's done with some structure, with some bells and whistles. And we've got a number of bullet points down here. Mandy, I don't know how if I've gone on too long here, but we've got a number of bullet points here that we could get into. But I would say that the objective is that we want to note that there's so many different flavors to an irrevocable trust. It could have something as simple as the child gets their assets in the trust outright at a certain age. It could continue in trust for their entire life. It could pass from one generation to the next, with the objective of not including it in their estate when they die. If it's so likely they're inheriting so much, then you're just talking about estate, taxable estate after taxable estate after taxable estate. There's grantor and non-grantor trusts, which is largely getting into how is the trust taxed from an income tax perspective while folks are alive and these trusts are being administered. And then there's other variations, and I'm sure many of you on the call today have heard various acronyms from time to time about people trying to look at different strategies around crats and slats and cruts and crats and all these different things. And the simplest way I think to view the acronym is to think of it as these are various planning strategies. Some of them involve distributions back to the person who made the gift. Some of them involve remainder interest being passed to charities. Some involve benefiting spouses. They are valuable and useful tools for the right fact pattern. And if it's something that clients are interested in exploring with us, we are happy to do so and to help walk through their particular facts and circumstances and see if it's something that's attractive to them and that they understand the non-tax components that go along with it. I'm happy to quickly hit on the next slide if you'd like and kick to Ken. So generally speaking, like I mentioned, you can do this in baby steps. You can do annual gifting. You can start to just utilize the power of gifting through outright gifts, annual gifts, irrevocable trust with fairly simple plans, fairly simple terms. You don't have to set up super complicated planning. And then there's a whole other world of kind of outside of estate planning in the traditional sense of wills and trusts and whatnot, that you can oftentimes work with your advisors, certainly your advisors at Summitry on, in terms of 529 plans, gifting for college education expenses, unlimited gifting for medical and educational expenses that are made directly to on behalf of people. And there's lots of tools to explore. We have a wonderful palette of tools to do our advanced planning and tax planning strategies, and working with your advisors to kind of hone in that list to something a little more understandable and functional for you is important to do.
Thank you so much, Gary. And yeah, these are all of the strategy that you can discuss with your advisor at Summitry, or if you're welcome to email hello@Summitry if you want to explore more specifically to your own financial plan and your own asset base. Okay, Ken, take it away.
Thanks, Mandy, and thanks, Gary, for going through some of those strategies and sort of the current landscape across the estate tax world. I'm going to switch gears here for just a couple of minutes, and then we'll get into Q&A. But we'll talk a little bit about preparing for these discussions with your family. How do you talk about this, especially with maybe adult children or young adult children? How do you think about those discussions as you begin this estate planning? First of all, you want to think about, how can you ensure what you're leaving behind will leave a lasting impression, and will hopefully be used in the way that really furthers your own goals and your family's goals. And getting there really requires a couple of things. First, gaining some clarity for yourself as far as your goals, and then some communication between yourself and future beneficiaries, trying to get to really a mutual understanding between the two of you of what are the goals for your family's wealth. And once you can reach that mutual understanding, you really will have a much higher chance of the beneficiaries really buying into your long-term goals. As sort of a quick example of that would be perhaps if a family has a family vacation property, whether that be maybe at the beach, at Tahoe, wherever, a cabin, and you as the owner really want that to stay in the family down the line. How do you communicate that through your estate plan? And how do you get your children's buy-in when there are associated costs with maybe keeping that property? And the same would go for wealth in general. Mandy, we can go to the next slide. So as far as sort of beginning this thought process and communication, you really start with what is it that you want to communicate to your children and grandchildren? What's most important to you? And as you're thinking through that, also think about what do you think is most important to your beneficiaries? Are those goals aligned, or is there space there to find a common goal? And then also, what do you desire most from your financial legacy? Is it to set up your children so that expenses aren't as big of a problem for them, or is it just to give them a leg up, or is it to ensure maybe that some piece of property or asset is kept within the family long term? And Mandy, we can go to the next. So as you do that, you'll want to clarify your own goals for this estate plan. You'll want to know how much will you need in retirement for yourself. You obviously don't want to set irrevocable goals that maybe jeopardize your ability to meet your own needs. Can you meet those needs with minimal principal invasion? Are there charities that you wish to support in addition to passing on wealth to your beneficiaries? And will you need to modify your spending habits to maybe achieve those goals? We go to the next, Mandy. You also want to define wealth, for your own lifetime and your legacy. Really thinking about what does wealth mean to you? Is that having enough to alleviate concerns about day-to-day costs? Having enough that how much you're spending is really of no concern to you? Or is it maybe being able to pursue altruistic endeavors, whether that be charitable or otherwise? And then think about what level of wealth you want to pass on. Just enough to give future generations a leg up, enough to cover the expenses for the next generation or subsequent generations? And are there any charitable intentions that you want to include in the plan? Mandy, we can go to the next. And as you've thought through those things, you really then want to foster effective communication with your beneficiaries about this. Reminder, communication should be adult to adult. Younger generations, they may be your children, but as you're talking through these estate items, you really want to make sure that they feel heard and taken seriously. The more they feel that way, the more likely they are to buy into the long-term plan. And also bear in mind that the model you set, the example you set in your communication, is often likely to be passed down from your children to your grandchildren and beyond. And younger generations really feeling invested with the creation of the plan and the stewardship of the plan are much more likely to carry out that vision throughout their lifetimes. If it's just that mom and dad want us to keep this cabin, that might not be as important to them in 20 or 30 years after your passing. if they've really had a hand in those discussions, they will be bought in and really try to pass on. This is a special family place that we want to keep for ourselves, for our children, for our children's children, for example. Mandy, we can go to the next. So once you've sort of started that communication, then you want to begin to craft a family wealth vision. Initiate those conversations with your family members about your definitions of wealth, their definitions of wealth, and try to come to some sort of mutual understanding. And then use those discussions to shape that shared family vision. Keep your own generation and future generations in mind while you're thinking about and discussing these things. And an important key item is to express your wishes in terms of desires for future actions, not mandates. Again, you're not telling them this is what you will do with the wealth I pass to you, but you're saying, I really would like to see this wealth that we've created be used in this way. And future generations' understanding of your reasoning will really aid in their acceptance of your goals and your vision for the long term. And then once you have that vision crafted, write it down, revisit annually, if not more frequently, and again, include future generations in those discussions. Remember, this vision is not carved in stone. It's really just an expression of your values and the desires of collective generations. So closing thoughts on that end, crafting and curating that shared family vision of wealth really can increase your odds of the outcome you desire beyond your lifetime, beyond the time where you can really influence those future generations. And also, these discussions can really draw family members closer together, assure long-term goals are aligned, and help younger generations to feel heard and valued. And with that, we will move forward to the Q&A.
Amazing. Well, as I mentioned at the very beginning of today's webinar, we had about 30 minutes of content. As you can see, estate planning has a lot of information that can go into it, and we can go down many different rabbit holes. So what I'd like to do is just make sure I can address some of the top questions that came into the Q&A during our presentation today. And I'll send these out to some of the panelists as they make sense. But real quick, Gary, if you wouldn't mind answering two questions in one. If I gift 19,000, do I pay tax on that 19,000? And two, if my wife and I own a house jointly and I pass away, is there a step up in the basis of that house for my wife?
Yeah. So I'll answer those both fairly quickly. There is no tax owed on the annual exclusion gift. You're allowed to gift that. And even if you were to gift over, you wouldn't necessarily pay taxes, but you'd use up your annual or your lifetime exclusion. On the home, the answer is if it's community property, you can receive a 100% step up in basis on the death of the first spouse. And if it was separate property, you would only receive a basis on the separate property owned by the deceased spouse. So in your example, the typical jointly owned community property home in California, first spouse passes, 100% step up in basis.
And do these assets need to be inside of a trust to receive that step up?
No, the step up is unrelated to the trust. The trust is primarily there for probate avoidance purposes.
Fantastic. Thank you so much. I think that's really helpful. Another question that came in is can I just have a will instead of a trust? And maybe I'd like to direct that one to Mandy.
Yes, so the whole idea behind the trust, and this is specifically for California, because when I was working as a financial advisor in Texas, and we have clients out of state like Colorado, the will itself is the main document to instruct how you dispose of asset. But in California specifically, the trust provide probate avoidance, which is a very lengthy, cumbersome, expensive process. It can take thousands and thousands of dollars before your heir will receive the asset if it go through probate. And also it could be 1 to 2 years. So having most of the asset in the trust will allow us to have a much more efficient transfer of asset and debt. And it's also provide an additional layer of privacy for the people who care about privacy, because anything that going through probate will be eventually become public knowledge if somebody cares to look into it.
Yeah, thank you for that. I have another one here for Gary. How does gifting from a bypass trust different from a living trust?
Ooh. I guess the simplest way I would say to you to answer that would be don't. You oftentimes aren't gifting from a bypass trust. A bypass trust is typically an irrevocable trust for the benefit of a surviving spouse. And it's going to have clear terms on what that surviving spouse and perhaps children are able to receive distributions for. Whereas when you're gifting from your own assets, which is typically held in your revocable trust or just in your own individual name. There's obviously a mountain of minutia and asterisks to that on some variations of irrevocable trust, but generally speaking, that's the answer.
Thank you. I have another question here, and I'd like to maybe pair it up with a second. So one, some context here. We have a number of clients who have family that live out of the country, and so a couple questions here that can be picked out of there. Who do we pick for trustees and or guardians if our family lives out of the United States? And then, do we recommend providing a stipend to a guardian for the care of minor children? Maybe that question, those questions can be directed to Mandy or Gary.
Gary, let me start first.
Sure, yeah.
And then I have you add in. Because this is a situation that my husband and I are facing, right? We coming from a different country. All of our family member is in a different country. They're in Vietnam specifically. We have a lot of friends and family member here. It's more important for the trustee to be specifically, we set up a trust for the benefit of my daughter, that the trustee need to be a US person because they're specific, very unfavorable income tax situation when there is a non-US trustee. For the guardianship, and the trustee could be a friend that you have here that you trust, or it could be an institution trustee, a third-party trustee that you pay to provide the service. For the guardianship, it's an even more nuanced decision that we have a lot of discussion with client about. It's coming back to, do you want family member to help taking care of the children, or is it more important for your kid to be physically in the US and continue staying, have the educations, have the living environment here? So it is a choice that every parent have to make for themselves. We made certain decision that it might not be right for many of my clients. Like my decision would be very different than the same decision that I have that I discussed with many of my clients. Gary, is there any more guidance that you can have?
I think you hit on a lot of the key items, and I think again it's probably just more reason to speak with your advisors and to be able to find the nuances that work best for your particular situation. And I can think of a couple examples of things like drafting plans to provide for temporary guardians to look over children for that interim period before they're able to move abroad with guardians located in another country or something like that. There's obviously, nuance to all of it and helping folks to walk through and reach the right decision and kind of indirectly in response to the stipend question, I mean, I would say that we don't typically provide stipends for guardians, but what we are doing is putting in language to ensure that assets that are held in trust for a minor after their parents have passed are able to be utilized in a way to make sure that that child is being brought up in the best home possible, whether that be, making sure that they have adequate financial support for additional childcare, even a remodel. You can think of any kinds of different fact patterns that folks, will bring to the conversation, and everyone's a little different. Ultimately, their direction to me is this is the right person to raise my child. How can we set them up for success? And that's what
Yeah.
Mm-hmm.
yeah.
Yeah, it's very helpful. I'd like to maybe extend the same thing, but a question over to Ken. So once you've created an estate plan, what do you need to share with the successor trustees or the beneficiaries?
Sure. I would say once you've created the plan, I think the most important thing to share, especially with the successor trustees, executors, et cetera, is the plan itself. Let them know that they do have this responsibility if you pass, as well as share with them, sort of where they can find listing of, especially the financial liquid financial assets, et cetera, bank accounts, brokerage accounts, any other investments that you might have, where they can find somewhat of a record of that and help them organize things. Um, Often if clients are working with a financial advisor, financial planner, the financial plan itself can be a great place to consolidate all of that. So if that's the case and you're working with an
Mm-hmm.
advisor, you might want to let your successor trustees know, hey, this is the person to call. They will help walk you through what is where and what needs to be retitled, et cetera. As
Yeah.
far as beneficiaries go, that kind of goes back to the portion we were talking about with discussing that family wealth vision, et cetera. That's going to be a little more individualized depending on the beneficiary. Obviously, you're not going to want to tell an 18-year-old you're going to inherit X million dollars when I pass. Maybe that's a different discussion, if the beneficiary is later in life and perhaps established on their own. So in terms of the beneficiaries, they don't really have to be told much of anything. It's really up to your discretion there.
Thank you. That's very helpful. I know that this was a big theme in the middle of our presentation, and Gary, you elaborated on it a little bit more. But there was another question in here. Let's talk about the anticipated changes for the estate tax exceptions, exemptions under the new administration. Now, I'll reiterate, we don't know what Congress is planning on, but I'll let Gary kind of elaborate a little bit more on kind of what we're expecting or what we're anticipating.
Yeah. Yeah, I think the short answer is that if nothing happens, the law sunsets and we revert to the prior law in from 2017, and we expect the estate tax exemption to go down from the current 13.99 million to around $7 million. That's an inflation adjustment estimate. And that would be again per person. So a married couple would have, we'd be thinking of it in terms of the combined 14 million versus the current roughly combined 28 million. But we don't know what's going to happen, and it could go up, it could stay the same, and every now and then you'll read up about proposals that completely turn it on its head, and one day that may happen, right? Get rid of step ups and basis, or change the have taxable events occur just because of death. I mean, there's all kinds of ideas that get thrown out there, but all we know now, as of today, is the current exemption sunsets at the end of the year, and that if nothing happens, it goes back to about 7 million per person.
Thank you for that. Now, as you alluded to, estate planning can be flexible, or you got to be nimble with it as the laws change. So, if clients or anyone else wanted to engage with you or Watson and Machado in general, what does that typically look like?
Excellent question. Excellent question. So generally speaking, with clients, if they're looking to engage with us to do their planning, we're going to sit down and meet with them and go through an information gathering stage to figure out the nuances of their needs and their objectives, and their kind of asset values and how it's allocated, and come up with the right plan at the basic planning level for them, and if it makes sense to incorporate advanced planning strategies kind of now or in the future. And if someone has an existing plan already in place, the only kind of difference between what I just said is we would also give a review of their existing documents, discuss with them what they like and don't like from a non-tax and legal structure standpoint, and then make recommendations from a tax and legal standard perspective standpoint, and then suggest updates as needed.
Yeah.
Yeah, Daniel, I would like to add, if you are a Summitry client, the financial plan that we put together for a client is the one of the best first step, because it already take into account a lot of the information gathering that Gary would need in upfront. Like our client generally have a net worth statement that would gather all their assets that give Gary exactly what he needs from the beginning. So that make the next step become very efficient.
Yeah, yeah, for sure. So we're a little bit over time. It's 5:08 right now, and I know people got to get back to their families. So what I want to do is just thank everyone for attending this webinar today, and just remind you that if you have specific questions that were not addressed in today's webinar, please reach out directly to your Summitry advisor. If you are not yet a client and you're attending this webinar, you can always email your questions to hello@summitry.com. And if you would like to be connected with Gary and his team, we can be sure to do that for you. So thank you again, everyone, for attending the Estate Planning Essentials for 2025 webinar, and we will be sure to see you soon in the new year.